The biggest complaint that I get from new option traders, I should say maybe the biggest grievance, the biggest issue, the biggest problem that they have is that they just can't get the stock direction right. You know, when you buy options and you hold on to that option, the stock has to move in your favor in order for you to make money. Now, I'm talking about option buyers that will hold the option all the way to the expiration date, okay? And typically what happens is the stock makes a little bit of move in the direction, and then for the rest of the time, the stock doesn't go where it's supposed to go, and the option expires worthless. So I hear this over and over from so many new option traders that they suck at picking direction. They just can't do it right. And the options that they buy end up expiring worthless. So if that is you, if you're in that camp, then this video today is going to help you completely change your mindset on what types of options you should be trading. And maybe you should not be an option buyer, you should be an option seller. So in this video, we are going to be talking about my favorite strategy of all time, which is selling put options, okay? In the options trading world, it is all about probability. And that probability is, will the stock move from point A to point B in the time allotted, which is the expiration date? And when you buy an option and you hold that option all the way to expiration, you have to get that direction right. The stock has to move at least above your break-even point in order for you to make any money. And the types of options that most traders buy are these out of the money, short dated expirations, and the stock doesn't make the move, or the stock makes a move, but the option already expired. So I want to try to convince you in this video to move on to selling put options. Now, option selling in general gives you so much room for error. You can be the worst picker of stock direction, and you can still make money by selling options, specifically put options. Okay, so we're going to talk about what selling put options is and why it's such a high probability type of trade. All right, so let's just jump right in and start taking a look here. All right, everyone, Lee Lowell here from smartoptionseller.com. We're going to talk about the easy plan for selling put options. Let me back up a step and talk to you about what selling put options is really all about. Now, as we all know in the options trading world, there's only two types of options. There's call options and put options. We're going to only talk about put options in this case. And there's only two types of players, option buyers and option sellers. It's that easy. Now, when someone buys a put option, buyer, they're expecting the stock price to go down. And the seller of that put option pretty much is expecting the stock to stay flat or go up. And even if the stock goes down, you can still make money. But the burden is on the option buyer, especially if they're going to hold the option all the way to expiration. If the stock does not drop like they expect it to, that option will expire worthless and they will lose the money that they paid to buy that put option. And the option seller is the one who collects the money up front from the option buyer. And if the stock doesn't make the move for the option buyer, the option seller ends up winning. As I said, for the option buyer, you can only win in one case if you hold the option to expiration. The stock has to move down far enough for you to make a profit. And for the option seller, the stock could stay at the same price. It could go down a little. It can go up a little. It can go up a lot. And you can win in all different cases for stock movement. The option buyer only wins in one case. The option seller can win in multiple different ways or directions the stock will go. Up, down, sideways. The only way a put option seller will lose is if the stock really drops really hard. And if you know how to do a little easy technical analysis, we're going to look at some charts here. If you can sell put options while stocks are in an uptrend, the chances are the stock's going to keep going up and the option seller's got an even higher chance of winning. So if you are really bad at picking stock direction, you may want to change your thinking and consider selling put options, okay? So when you sell a put option contract, you are entering into an agreement to potentially, and I say potentially because it's not guaranteed, you are potentially on the hook to buy 100 shares of that stock at a certain price level. And you're choosing all these levels, okay? If you're the put option seller, you can choose what level that you want to potentially buy the stock. And you will be paid upfront from the put option buyer by selling that put option. It's like selling insurance to somebody. When you sell something to somebody, they pay you. As the put option seller, you're getting income. Now, and all you're going to do is figure out whether you have to buy the shares of stock or not. Okay, so let's just go over this little easy plan here. So number one, you want to decide, you want to pick a stock that you're bullish on. Okay, you have to do a little research ahead of time. Look at some charts, look at some research, figure out, okay, I am bullish on this stock and I like this stock. If I have to buy this stock, I am okay with that. And number two here, you have to decide on a price level in which you would be comfortable potentially owning shares of that stock. If that stock is currently at 100, where would you want to buy it? 95, 90, 85, 80. You decide based on your research ahead of time where you would want to buy that stock. Okay. Third step. Once you've decided on the stock, once you've decided on the price level, you would be okay potentially buying it. Then you have to go through the option chains and see how much money you could receive for selling a specific put option contract. And we're going to look at the option chain as well. And options expire almost every month. Some options expire every week, and certain options expire every single day. Okay, those are called zero DTE options, 0 days to expiration. The indexes like the SPY, the triple Qs, they have options that expire every single day. And a lot of mainstream stocks have options that expire every Friday. And then some of the old school stocks have options that expire once a month. But I think most stocks these days expire every Friday. So we'll look at the option chain and we'll look at some option contracts. So you choose the expiration date. Now, the longer you go out in time in expiration, the more money you will receive as the option seller. So we're going to look at a couple different months and we'll see how much they pay. And then once you've decided on the option, you sell that put option, you collect your cash. Okay. Now you've sold the put option, you got your money. Part two, you wait until the expiration day to see where the stock ends up. Only two things are going to happen at expiration. You're either going to be assigned shares of that stock or you won't, which means the stock price either has to come down to the strike price, and that's the level that you want to potentially buy the stock. So if the stock's at 100, it either falls down to your strike price or not. So you'll either have to buy the shares of the stock and pay for it at that time, or if the stock doesn't fall far enough, the option will just expire worthless. The option buyer will lose their money and you get to keep the money. And now you just right here, wash, rinse, and repeat. Keep rolling these trades over and over. If the stock doesn't fall to your strike price, option expires worthless, then you sell another put option, collect more money. And if that expires worthless, you sell another put option, collect more money. In very rare cases, depending on which strike price you choose, you will get assigned, you'll have to buy the shares of stock, pay for them, and then right here, then you can sell covered calls. That's a topic for another video, but it's another chance to earn even more income. Okay. Now, all of this, options do not have to be held until the expiration date. If you're the seller of an option, if you're a buyer of an option, and if you are uncomfortable for any reason in the trade whatsoever, you can always unwind the trade and get out of it. Okay. So let's look at a stock chart here, run through the example and show you why, in many cases, as the option seller, picking the stock direction is not the biggest factor on whether you're profitable or not. Okay, so let's just pull up the stock chart here, and let's look at, we've got Tesla pulled up here, and I use Tesla only because it's such a popular stock, and it's also got so many bullish people that love Tesla. So let's just assume, okay, for argument's sake, let's assume that you are bullish on Tesla. You do not have a position yet, but you want to get long shares of Tesla because you are bullish. And you have to decide, what level would I be okay potentially buying shares of Tesla if it came down to it. Now, Tesla closed around $302 this past Friday, August 1st, 2025. Where would you be comfortable potentially buying shares of Tesla? Now, for us, if you want to have a lot of cushion for directional error, you want to sell what's called the out-of-the-money put options. Out-of-the-money put options have their strike prices, and we'll look at the option chain in a second. Their strike prices are listed below the current price of the stock. So anything below $302 in the strike prices is considered out of the money. Now, really far out of the money is strike prices all the way, way down here. And I'm going to show you how that works for Tesla. But let's assume you're bullish on Tesla and it's at 302 and you're thinking, okay, I'd be okay buying Tesla at, let's say, $250 or $225. 225 is right here. And that's really where the last swing low on the stock was back in April when President Trump announced the tariffs and all that. So you're thinking $225 has a pretty good support level going back, about a year now. Okay. So you're thinking, all right, I've done my due diligence. I know I'm bullish on Tesla. I love the company. I love Elon Musk, maybe. And you're looking at your charts and you're thinking $225 would be okay for me to potentially buy shares of Tesla if it came down to it. It's at 302 now, $225. You've got a $77 cushion, okay, between the current price of the stock and your strike price, $77. That means if Tesla closes anywhere from 225 or higher, that means that option will expire worthless. So you as the option seller have all these places that Tesla can go. Tesla can stay the same, Tesla can go up, Tesla can go down, but not below 225, and that option would expire worthless and you would win on the trade, meaning you keep the money from the option buyer and the put option buyer lost their money. Now, if Tesla falls below 225, then you will be you'll be assigned the shares. You'll have to buy 100 shares at 225 and pay out $22,500. So you have to make sure that you have the money ready to go at expiration if you have to buy the shares. Okay, so you got to make sure you can only sell put options on stock prices that you can afford to buy at least 100 shares. So let's look at the option chain. And I'm pulled up Tesla here. This is a Tesla option chain. So here's the put options that we're going to look at. So you've decided $225 is the level that you would be okay potentially buying shares of Tesla. So you want to sell what's called a 225 strike put option on Tesla. Now here's the smattering of the expiration dates that's just shown on the screen here. If I click on the More tab, here's all the other expirations going all the way out to December 17th, 2027. Now, as I said earlier, the longer out in time you go, the more money you will receive. So let's just take a look at these longest dated put options. Now, the 225 strike is not listed all the way at here. It's either 220 or 230. So we'll err more on the side of caution and we'll look at the 220 puts. These are worth roughly $41 and let's say 10 cents per contract. 41.10, somewhere right in between this. There's a bid, there's an ask, and fair value is somewhere in between those two numbers. So we'll say $41.10 per contract. That's $4,110. If you sold this $220 put, you would get $4,110 immediately placed in your stock brokerage account. And that money sits there and you can do whatever you want with that money. And it'll sit there and it'll earn interest if your broker is paying interest. Now, until December 17th, 2027 rolls around, if you decide to hold the trade for that long, the line in the sand is, will Tesla fall from 302 all the way down to 220 by December 17th, 2027? But you don't care. You're okay with potentially buying Tesla. Now, in between now and December 2027, lots of different things could happen. And as I said, you can always get out of the trade if you want. Now, this option price does not stay the same for the life of the trade. It go up, it can go down, but over time, it'll work its way towards zero as long as Tesla stays above your strike price. Now, let's look at October 17, 2025, which is a little bit more than 2 years earlier. Now, we'll look at the 225 strike here. Here's the puts, bid ask right here. Let's wait for it to populate. So in this case, the 225 puts are worth $4.30 per contract. To find how much you're going to get, you have to multiply these numbers by 100 because there's 100 shares in each contract. So you'll receive $430 to sell this put option, this 225 strike put option that expires in 76 days. Now you can go back to the chart of Tesla and you're thinking to yourself, can Tesla fall to $225 in the next 76 days? That's down here, okay? So as I said earlier, option trading all comes down to probability. Can the stock make the move that's necessary within the time frame? Now, good thing for us is that we have what's called a probability calculator, which we have on our website, the Smart Option Seller. If you want to see what the chances are of the stock falling or going anywhere, you can use the option calculator, probability calculator any way you want to see whether a stock can go up, go down, whatever. So let me show you how we use it. So I put in the current price of 301. Is it 301 or 302? 302. Okay. So the inputs up here and the outputs are down here. So $302. We're using the October 17th, 2025 expiration date. It's got 76 days in the future, which is exactly the same as it shows on the option chain. Okay. Now you can put in any number you want here and it'll change the date up here, or you can change the click on the calculator box. Okay. And then this number will change. Now future volatility. Now what volatility tells you is how has, the stock of Tesla fluctuated over the past and how it's expected to fluctuate in the future based on its past movement. Okay, in this case, this is 50%. It's a percentage number. You don't have to type in the percentage number, just type in 50. Now, we want to know what the chances are of it falling down to $225 in the next 76 days. And then we click on go. So down here, it tells you what's happening. This box and this box. Now here's the option buyer's probability to win, saying finishing below lowest target. So as the put option buyer, they absolutely need Tesla to fall below $225, actually down to $221 because they paid $4 up front for that option contract. So if we want to find out the true odds of just breaking even, we go down to 221. Okay. There's only an 8.5% chance that Tesla will fall down to $221 and stay down there by the expiration date in October. So here, this is the probability of the option buyer winning on their trade, or at least breaking even. This box over here is the option seller's probability of winning. 91.4% chance of winning on the trade. And by winning, I mean Tesla stock will not fall to $221. Okay, so if you sold that put option for $4 per contract, your break even is also $221. Anything below $221 on Tesla, you will be starting to lose money because you'll be obligated to buy Tesla at $225 a share. You collected $4 up front, so your break even's $221. If Tesla is below $221 at expiration date, you will be holding a losing trade. But for you, that may be okay because you want Tesla for the long term and you thought $225 was a support level on the stock and you're just going to wait for the stock to rebound. And you can also sell covered calls. Now, if we go back to the option chain here, let's just pretend, you have 76 days for a future expiration and now you want to sell call options. If you had to buy the Tesla shares, now you can sell some call options. Okay, your cost basis was $221, and if you're going to sell a new contract that has 76 days, let's assume it's October right now, so you move forward 76 days, and these option prices could be the same. You can sell a 280 call for over $4,000 you can receive. So not only will you receive $4,000, but you'll get the price appreciation from your 221 cost basis all the way up to 280. So that's almost $60 of just appreciation on your 100 shares. That's $6,000 on top of the $4,100 you'll get. So that'll be about a $10,000 payday if Tesla rallies back up. Okay, but that's another video for another time. So the bottom line here is that as the put option seller, you have over a 91% chance of winning. And by winning, I mean Tesla doesn't fall that far. You'll keep your $400 and then you can sell another put option for another 76 days in the future or for however long you want it to be. Okay, so that's really about all it is. Think about it. Tesla's at 302. As the put option seller, you can win with Tesla stock being in so many different areas. Tesla could stay at 302. It could go down to 300, 270, 260. You're still winning with Tesla in all these different price levels. Tesla can go up to $500 and you'll be a winner. The put option buyer in this case, the only way they could win if they hold it to expiration is if Tesla drops down to $221. And that's only giving them an 8.5% chance of winning. Is that enough percentage for you to be an option buyer in this case? Now, as I've told students, if you want to be an option buyer and you have a profit built up before the expiration date, you better take that profit, because if you hold it all the way to expiration, the chances are the stock's not going to cooperate with you a lot of the times. So if you have a profit built up as an option buyer, please take the money and run, okay? The longer you hold it, sometimes the less chance you'll have of winning. But as the option seller, we like to make these trades. This is our bread and butter at the Smart Option Seller. We sell put options. We sell these out-of-the-money put options, have high probabilities of success, and we can win in lots of different areas for the stock to fluctuate in. It gives you a huge margin for error as a put option seller. And in the end, you may end up buying a stock that you like at a really cheap price. And then the stock could rebound and you can hold that stock, make a lot of money on the upside appreciation, and sell covered calls and bring in even more cash. It is the reason why I call it the greatest strategy on earth, selling put options. Now, if you want to take a deeper dive into what selling put options is all about, I've got a video series here. Okay, let me click on this. Here, let me bring up the other page. This is our 5-part deep dive video series on selling put options. It's 5 videos, about 5 hours long total, all about selling put options, why it works, why we love it so much, all the things that you need to consider when you're selling put options. And as a bonus, if you buy this video series, you get 30 days free to our newsletter, our put option selling newsletter. You get the trades that we make. And along with that, you get access to the probability calculator that I've just been showing you. All right, so if you want to take a look, scroll down, you can read all about it, what you get, some testimonials, and you can see the price and all that, some Q&A down here. All right, so that's really about it. This is why selling put options is our bread and butter. Huge probabilities of winning, huge cushions for error, and they work out more often than not, over 90% chance of winning on just about every single trade. And it depends on which strike price you choose, okay? You can choose a higher strike price that's closer to the current price of the stock. You'll get more money, but then there's a bigger chance that you'll have to buy the shares of stock. But if you're okay with that, then that's all that matters. All right, so that's all for selling put options, how to get big cushions for directional error if you're really bad at picking the direction, and high probabilities of success. All right, that's all for this video. Please give me a thumbs up. Please give me a like. Tell your friends. Leave me a comment. Send me an email. I'll always answer your emails. I make these free videos for the trading community, trying to help everybody out. Down in the description, I'll also put a link for the video series, the 5-part video series. Take a look at that. And that's it for me. I'll see everyone in the next one. This is Lee Lowell signing off.